investors. This is Chris Benson, Chief Investment Officer at Reliant Real Estate Management. Appreciate you taking the time to walk through Reliant Self-Storage Fund 2 with us. Today I'm joined with Todd Allen, Managing Principal at Reliant. Good morning, Todd.
Morning, Chris.
Thank you for joining us. And also John Cordova, who's our Director of Acquisitions. John, good morning to you.
Good morning, Chris.
Well, guys, before we get started with the specifics of the fund, I thought we'd just take a quick moment to discuss a state of the union. Obviously, there's a lot of volatility in the market right now with what's going on with the COVID-19 pandemic. And what we thought we'd do is just share with you how it's affecting a few parts of our business. So I'm going to turn it over to Todd to give a sense of what we've seen from the operations side. Today is April 9th as we're recording this. So, we're about 30 days into how this has affected us. And so I think Todd can share with you what ops is seeing and at our specific facilities across our portfolio. And then I'll turn it over to John to give a sense of what he's seeing on the acquisition side of things as we continue to underwrite deals. So Todd, maybe you just share with everyone what your thoughts are on what we've seen in this first 30 days.
Sure. The self-storage asset class is very, very unique because, why it did so well in the recession previously was because as people downsize, they need self-storage because they always have the thought process that better days are ahead. So when you're going from a 3-bedroom down to a 2-bedroom, you go and you store that 1 bedroom. And then also when times are good, for sake of a better term, people have more toys, people have more stuff, and they're also using self-storage. So we did not feel that we were going to see the force of the pandemic hit the self-storage asset class very quickly. And you can take a look at the stocks and see that the self-storage asset class is still faring fairly well as you look at the stock market in general. And so in general, when you take a look across our portfolio, what you would see is that through the month of March, we actually had the better leasing than we did in 2019, and that was due in large part to the students from college and universities that closed down earlier and sent their students home. So they utilized the self-storage product earlier than we expected. Normally they use it in April. Plus on top of it, as COVID was becoming more and more ingrained in our society, the move-out notices, which normally we have about a churn rate of about 45 to 50%, meaning that's how many move out versus how many lease. And that slowed down tremendously. Most people push their move-out dates 30, 60 days in advance, so it really helped the sites to net. So in looking at our portfolio, there were only 3 sites, and at that time we had over 60 sites that were with us. We recently had a sale of 14 of our sites, but of those 60 sites, 95% of them actually hit their budgeted goals on their physical occupancy and their total revenue. So it was a very strong month for the month of March. As we go into April, though, what we were hearing at the end of March was that as we were trying to collect on the accounts receivable, we were hearing, people started saying, hey, we're losing our jobs. What are you going to do for us on late fees? Are you going to do any concessions on rent? And so that became more prevalent. And so right now, across the industry, self-storage is not doing anything as far as concessions or promotions for those late fees. We believe that the government has put in action plans that are allowing people to keep their jobs and keep their paychecks. And so until we see it become a real problem, we're going to take everything on a case-by-case basis. I looked at the numbers just this morning, and our accounts receivable is actually lower across our portfolio this month than it was in March at the same time. Our physical occupancy is the same, and our total income is actually higher. So we do expect this to affect the self-storage industry in general. We don't really know when it's going to, but a safe bet would be that we would start really seeing effects at the end of April and May. I think those are the 2 months that we're really going to see, and they're going to be the linchpin to handle how we handle the COVID crisis going forward. We all hope that self-storage fares as well as it did in the recession. And, the nice thing about us is that we are an essential business. So we're still open. We have taken steps to safeguard our employees, our team members, as well as the customers that come in. We've opened up online leasing. We've done all types of things where we've moved everything to the web in order to continue our fiduciary responsibilities to our equity investors, as well as our moral and our general responsibilities to our customers and our teammates. So right now, we have fared well. We're going to continue business as usual and adjust as things occur.
I appreciate that. So I think that's a good overview across the board. And as Todd said, I think time's going to tell there. We're going to see, what April shakes out like, and also, the month of May. And certainly as we're recording this, we're starting to see some momentum and recovery on the health side of this crisis. And, hopefully we'll have a trailing indicator of the economy doing the same thing. So I guess shifting gears, John, what are you seeing on the acquisition side? Maybe you could share with the listeners as far as, are you seeing volumes drop off as far as listings, things being sent out, or on the underwriting? Have you changed anything as far as underwriting metrics are concerned? I think that'd probably be a great overview.
Sure, Chris. In terms of acquisitions, I would say in terms of volume of listings coming our direction, that has slowed down. It has not stopped. I got 2 or 3 this morning. So it certainly has not turned off, but has slowed down. In terms of deals that people are pursuing and that we started looking at prior to COVID-19, the offers are not coming in. You hear stories of, I had 2 or 3 or 4 groups very interested and planning to make an offer, and when you follow up, those offers haven't come in. So I think that there's been a pause on people going forward with offers at this point. I think for fear that they just don't know what the real price is at this very moment. So I think there'll be a little bit of a pause in terms of people moving forward on offers, and some of those deals will probably sit for a bit till things stabilize. In terms of our underwriting, we haven't made made very maybe small nuance changes, but nothing of any material, because we still feel like we're buying investments with a 5, 6, 7 to 10 year horizon, and we feel like this will be behind us before that. So there's no real reason to make any drastic changes at this point. I would say the part of our cog of the wheel that's probably changed the most is the lending side, and it hasn't been that lenders don't want to lend on deals. Part of it's been that lenders have turned their focus to the SBA loans and getting all these payments out to small businesses. So it's been more of a shift in focus on the lending side. I think there are some lenders that probably are pausing just because they don't know what tomorrow looks like. But there has been a greater shift in just their focus of their attention more than anything.
Yeah, I think we're probably seeing that across to, all asset classes. I'm sure some of the listeners have read about when they launched the Paycheck Protection Program and the amount of volume that banks and regional and local banks are seeing. And that's happening all across the board, even to the Banks of America and Wells Fargo, the big boys.
I'll add one point. When the lenders we've spoken to have said, if you were many other sectors, retail, hotel, go down the line, we probably wouldn't, quote unquote, be answering the phone right now for you. I think the self-storage class is still looked on very, very favorably. And frankly, some of these lenders are still talking to us because we are in the self-storage sector. So I think that's a feather in our cap, and something that will, as we come around the backside of this, we'll be at the top of their list to re-engage with as well. Yeah,
it's a great point. I think sorry, Todd, go right ahead.
Yeah, the other thing that I would add to that is, because of the payroll stimulus Act, that was really the thing that pulled a lot of our lenders that we have used in the past back in, and they were focused more on that aspect rather than lending commercially. So as soon as that gets all sorted out, which, you know, who knows when that is, but at the exact same time, it's not because of the deals, it's not because of the self-storage asset class. All of the opportunities, I mean, we've heard numerous banks say, you know, they would have loved to have, and if we would have provided it to them 30 days in advance, they would have lended on it back then, but they have to remain focused on the payroll stimulus and the SBA loans at this point. So, you know, as you were saying, Chris, to your point, is the minute that all this becomes gets put behind us, and they release them back to loaning commercially, you know, I don't think the self-storage asset class is in any danger whatsoever of not being able to pick back up from where it was, you know, 60 days ago.
Yeah, and Todd, what I would say as sort of transitioning to the discussion around Fund 2, you know, you touched on it, that the historical nature of self-storage is it's performed very well in the recession. And you know, we've asked this question internally: why would we launch a fund in, you know, the midst of this economic turmoil that's been created? You know, arguably the worst time to go out and raise money. And I think for our perspective of it is, I'm not saying that this fund will be a distressed fund only, and we'll only be looking at distressed opportunities, but we do want to be prepared for what we think is coming. And there's certainly going to be some impact, or at least our impression is there will be some impact in the self-storage asset class, where there will be some sellers who are in a position where they have to get out of a property. And if the lending markets have tightened, it may be more challenging for them to refinance that debt. So I think that's a good transition to what we're talking about here is Fund 2. Our perspective is, you know, let's be prepared. If those opportunities are out there, we can be nimble. Typically in a recession or in a downturn, the best buying opportunities of the cycle exist. And, you know, we certainly benefited from that in the last downturn in 2007, 8, 9, and beyond. And so we're trying to be prepared for that and stack some dry powder. And, you know, John, I don't know what your thoughts are, but if that doesn't happen, let's say there isn't a correction, what do you think will happen in the marketplace?
Well, from talking to different brokers and following up on deals that we're chasing down, or even have gotten the listing package on during this time, it seems that because the market was so strong before the COVID-19, and because the lending environment was so strong and interest rates were so low and occupancies were strong, that the folks that were looking to sell were looking to really sell at the top of the market, or get a price that was very strong. And they're not going to take something lower, because I think that the general feeling out there is this thing will pass in a relatively short amount of time. I know that's for people that are dealing specifically with the virus, that doesn't feel like that, but just, you know, if let's say it's 6 months even, or 9 months, that they're not willing to sell their property at a 20% haircut, so to speak. They're willing to wait. They have the cash flow. They have enough you have a good loan situation, good leverage, if leverage at all, and they're willing to wait this out. If you told them it's 5 years, it's probably a much different story. But I think everybody sees this as let's call it a 2020 problem that probably by 2021, if not sooner, will right itself, and they'll be able to go out to the market with a similar price point. And I think that's where the sellers stand at this point. So we want to be ready to take advantage of that as soon as that comes back to be the case.
Yeah. So if I were to say Reliant Self-Storage Fund 2, it's not a distressed fund, but certainly we're preparing capital if those opportunities present themselves. And if they don't, then we're going to be in a position where we're going to be able to acquire properties through the strict underwriting process that John and his team work through. And because of the segmented nature of self-storage, there's still going to be opportunities to be had in the market. So let's get into the details of this. Just really quickly, I wanted to start with a disclaimer, and I won't read this, but certainly this deck is available for you to download, and you can read through it. But essentially what all of it is saying on the disclaimer side is we're making predictions based on the information we have of today, and certainly those could change. You should do your own due diligence, run this by, the professionals that you trust on the legal side and potentially the financial and tax side to see how that may impact you specifically. But, I think for the most part, we do a pretty good job of outlining the information and giving you transparency to it so that you can make your own decision. What is Reliant Self-Storage Fund 2? I think we talked about it, but we're using this fund to acquire and develop a diversified portfolio of self-storage properties across the U.S. Our goal is to be able to deliver passive income quarter by quarter. So each year we're going to be making a distribution to you quarterly for an annual return. And then certainly the appreciation of those properties when we sell and share the profits. In this case, over a projected 6-year hold time. Our goal is to, at a minimum, raise $15 million to purchase the 5 properties that we currently have under contract, and we'll talk through those in just a few minutes. We have the ability, the fund has the ability to raise up to $50 million in equity, which will be our goal. The time period in that is we'll have the ability to raise that $50 million over a 12-month period. The Why Launch Fund 2, I think we talked about, we hope that everybody makes it through safely and doesn't have a huge impact. But if there is an impact with some opportunistic buys, we want to be nimble and have the capital available to take advantage of those. And there's a quote by Warren Buffett that I'm sure many of you have heard before. But be fearful when others are greedy, and greedy when others are fearful. And typically that turns out pretty well as far as the business cycle. And then the last piece is, look, we understand that this is a time of volatility and uncertainty. And the question is there an incentive to being part of the first money into the fund? And yes, what we've done is said, look, we understand that this is an uncertain time. So for the first $10 million raised in the fund, everyone will qualify for a Class A share. And we'll walk through the specifics in a moment of what Class A, B, and C is, but typically the Class A share has a $5 million investment minimum. And so what that means is if you were to invest $100,000 in the fund, you would be getting the same terms as an investor who invested $5 million. So in our case, that's an 8% preferred return with an 80-20 split versus a 70-30 split. So the idea is to give you an incentive to move forward now when times are uncertain, and you can reap the benefits of that in the total return that you'll share with the fund itself. What I wanted to do with this is just give you a quick overview about Reliant, a quick snippet on the properties. We're going to go into each of those 5 properties in more detail. We'll talk about strategy and just a quick touch on a track record of Reliant, our historical operating prowess. So Todd, why don't we just turn it over to you just for a second with a quick story about how Reliant Real Estate came to be. There's a few bullet points obviously on the slide that our listeners can watch or our listeners can read, but I think a little bit more on the story of how it came to be would be helpful.
Yeah, as most of you know, Reliant came about in 2009. It's a partnership between Lou Pollock and myself. We started out as a developer of self-storage, and then kind of transitioned into retrofits, meaning taking a dark box, a grocery store or something along those lines, and converting it for the self-storage use. Then we got into acquisitions, and what we've landed on are value adds. We believe that value adds, because it doesn't really matter how you buy them at this point in time. It just matters, about the final returns, and John can speak more to that than I can at this point anymore. But value adds work no matter what's going on in the country, in the economic climate. And so what we've really looked to do with our past portfolio and this portfolio is be opportunistic and take advantage of value add opportunities as well as some cash flowing opportunities. And so through that whole growth, we are now up to 44 sites, about 4 million net rentable square feet, and right around 29,000 individual units. So I think we're the 25th largest in the country as far as an operator, with right around 130, 140 team members or employees. And we are currently located in Roswell, Georgia. That's where the corporate office is. And I think that pretty much brings everybody up to speed.
Yeah, and I think as you look at investments, we say this quite a bit, is you're really investing in team, not the properties. And so you have a really experienced team with an intimate knowledge of the asset class. In the past 5 years, over $650 million in transactions. We just closed a 14 property portfolio that we sold with an equity partner in early March. And so, we have a lot of experience on both the acquisition and the disposition of these assets with a really strong track record. And I'll touch on that really quickly. It's down here on the bottom of the screen, but we've sold 22 properties, not including that 14 property portfolio. We have not finalized the numbers on that, so we've not included it in our portfolio averages. But of those 22 properties we've sold, our average IRR is just below 44 in a 2.91 equity multiple, which means if you had invested $100,000 across all 22 properties, your average return, we would have returned to you $291,000. So we've had a really strong track record. We've never lost a property to the bank. We've never made an investor capital call, and we've never lost investor principal. So, we've had a good run, and we expect that to continue, even with the uncertainty of what's happening right now. And I think, as you look to understand where you're deploying your money, having a strong team with good experiences is a key part of that. Really quickly, I'm going to go through the properties. We have 5 properties that will seed this fund. It's actually 5 individual properties. One is a 2-property portfolio. They're spread across 4 states: Tennessee, Georgia, North Carolina, and Alabama. The mix of the current properties is, with 3 value adds and 2 that are cash flowing and almost to stabilization. And so, John, when we walk through the individual properties, give you a little bit more detail on each of those. And then, on the strategy of the fund, look, the goal is to create passive income quarterly for our investors, and then through the appreciation of this portfolio, create an outsized return for you in our term holding period. And we're going to do that through a mix of value add deals, as Todd talked about. Historically, we've done quite a few of those. Stabilized assets, which would be a facility that's full, and essentially we're just going to manage it. And then a development deals will also be part of this fund. Now, we've limited the amount of dollars that can be dedicated towards development to also limit the risk for investors. But we did want the opportunity to do that because there's certainly some upside in that. And we'll talk through the limits on that as we go through the terms. Last piece is, as I had mentioned before, we expect to hold this fund for 6 years. But keep in mind, we're opportunistic. If we are offered a wheelbarrow full of money for this portfolio previous to 6 years, we may exit then. And if market conditions aren't right at year 6, we may say to our investors, look, let's hang on to maximize the value of this portfolio. And last thing that I would ask that we get a lot of questions on is, do you have to sell the properties as a portfolio? The answer is no. We could sell them individually. Let's say, we end up with 10 properties in the portfolio. We could certainly sell them individually. But typically there's a premium paid for portfolios on your exit valuation. So it behooves us sometimes to bring a portfolio of properties together and sell them that way. So just getting into the terms of the offering, the fund itself is a Delaware LLC. You'd be coming in as an investor in a member of that LLC, and the management agreement would be through Reliant. fund manager 2. So, Reliant would be managing all of the properties internally. We talked about the strategy. Our goal is to buy, stabilize, value add, and add some development deals to the portfolio. Our targeted returns are at this point between 12 and 15% cash on cash return over the hold period of the fund. So let's assume we get to that 15% return over 6 years. That would be a total return of 90%. So if you were to invest at $100,000, the goal would be to return to you $190,000. We talked about the target fund size. We're going to raise a minimum of 15 million with a maximum right now of 50 million over a 12-month period. We'll start making those capital calls here in April as we launch Fund 2. And as I mentioned, it's 12 months, so that will be April 2021 when we close it. 6-year term. Just walking through the fee structure really quickly. And in the frequently asked questions section, we also do a deep dive into each one of the fees. But acquisition fee is 2% of the all-in cost of each property acquired. That's a one-time fee paid at the closing. The development fee is 6% of the capital expenditures of a budget. So if a property has significant amounts of capital being deployed for construction, for example, that 6% fee would apply to that. If there is no budget for that CapEx, then there is no fee. And again, that's one-time fee paid at closing. There's an investment management fee. It's 0.65% on the equity deployed. So, if we deployed $50 million, that 0.65% would be on the 50 million deployed. It's paid to Reliant quarterly, but it's, an annual fee divided by 4. So it's not like that 0.65% times equity deployed multiplied by 4. It's just paid annually. And then our 6% property management fee, as I mentioned, we're vertically integrated, meaning we manage the properties we buy. So as Todd mentioned, we have a corporate headquarters here in Roswell, Georgia, but we have team members in all of the states where our properties are. And so that 6% property management fee covers the overhead of running that. And that's 6% on the gross revenues of the property, and that's paid to Reliant monthly. The individual class members, so minimum investment, there are 3 classes of share in the fund. For the Class A members, it's a $5 million minimum. For the Class B members, it's a $1 million minimum. And for the Class C members, it's a $50,000 minimum. And the investment structure for those classes are, for the Class A, it's an 8% preferred return with an 80-20 split to any dollars above that. With Class B, it's an 8% preferred return with a 75-25% split. And then Class C members, it's an 8% preferred return with a 70-30 split. So obviously we're trying to incentivize larger investors. Keep in mind that as we had mentioned from the beginning, if you are investing in the first $10 million of the fund, everybody will be a Class A member. So even if you invest $50,000, you're going to get the same terms that a $5 million investor would be to incentivize you to be the first dollars in. An IRR hurdle. So what that means is when we hit IRR, for those of you who don't know, stands for internal rate of return. It's essentially a measure of a rate of return factoring in the opportunity cost of money. So the time in which your money gets distributed to you. And so that IRR hurdle is a 14. So after we return a 14 to you as an investor, then the waterfalls change. So for our Class A members, rather than being an 80-20 split, once we hit that 14% IRR hurdle, it goes to 50-50. And Class B from 75-25, it goes to 40-60, and Class C goes to 30-70. And the goal with that really is to say, if Reliant outperforms what we're originally projecting to you, then we're going to share in more of the upside. So, it's giving us that incentive. Obviously, we make a lot more money if we outperform, and so do you. Distribution from a capital event, just walking you through that real quickly. There are 2 ways a property makes money. One is a distribution from operations, right? So the essentially profit monthly after you pay all your expenses. What happens there is all of the money goes to the 8% preferred return first. And if we pay past that, then we would split it to whatever class waterfall you have. So in class C, it would be to 70/30. Now, remember, that's at the fund level. So we'd have to deliver an 8% preferred return across all the equity in the fund, not just an individual property. And then the second way property makes money is through a capital event. And so that can be a sale or a refinance. And in those cases, the waterfall is just a bit different in that we first have to catch up that 8% preferred return. And then we return 100% of your principal. And then whatever money's left after we return that, then it gets split by the class member that you have a share in. So the idea is that the investor gets 8% preferred return or an annual return of 8%. Then they get all of their capital back. Then Reliant gets to share in the profits from the sale of the portfolio. Co-investment. So Reliant will be investing 3% of the aggregate fund size. So if it's a $50 million fund, Reliant will be investing $1.5 million. We also do not require investors to sign on the notes. If there is recourse debt, Reliant will be signing on the notes, and we do not charge a loan guarantee fee. So we consider that part of the skin in the game as far as the fund is concerned. And then just restrictions on the investment type. So, no single asset equity investment can be larger than $15 million. That doesn't include a portfolio sale, but in a single asset, we're saying we don't want too much of the fund's performance to be weighted on one property. So we try to limit that. And then secondly, on the development side, as I had mentioned, we're not going to spend more than $5 million of equity on the development side of things, with the goal of that making less than 10% of the fund, if we go to $50 million, allocated to development, because certainly there's a different risk associated with a development deal than there may be with a stabilized asset. So that's the high level on the terms itself. As I talked about before, I think the team is a critical component of this. You have three of us here, Todd, myself, Chris Benson, and John Cordova on the call with you. But we have a team with a deep knowledge of the asset class and a lot of experience. And so, and we're a pretty good group of guys to boot. So I think that's a key component. There's more in-depth bios on each of us towards the back of the slide deck, which you can explore at your own with your own time. So just a real quick, for those of you that the asset class is new to you, self-storage, and the question is why, I'm going to hit on three things, and then I'm going to turn it over to John to talk through our underwriting process. But, the one is historically self-storage has performed very well. The data that I'm referencing here is from the National Association of REIT, and that's public data. The reference is down below. You can look at the same website we do. And they look at all the historical returns of the REITs across all asset classes. And why it's nice is it's 25 years plus of data at this point, and you can look at office, retail, apartments, self-storage, and see comparatively how the REITs did compared to each other. And so storage in the last 25 years has done just under 17% a year, which is obviously a fantastic return. You see some of the other asset classes here on the slide. Apartments did 13, also really well. Office at 12. The S&P 500 during that same time period, to give some perspective, is 7%. So it's performed really well. The next thing that I would ask is, well, how's it done in a recession or downside, and especially in the times that we're in right now? And historically, we can look back to the last recession, 2007, 8, 9. Storage did very well. It lost less than 4% of its value when they were looking at the REITs. And then you compare that to the apartments, down just under 7%, retail 12, office 8, and obviously the S&P 500 got crushed in the last recession, down 21% during that 3-year period. So Todd spoke to it earlier, but typically, Americans don't seem to lose the appetite for storage, even when economically things are impacting them. So I think time will tell with this particular cycle, but we hope the same thing holds true. And then lastly, market consolidation opportunity. So if you think of self-storage as a pie, less than 20%, 20-25% of that pie is owned by 6 publicly traded companies. There's 5 REITs. If you live off a major highway, or if you're driving down a highway listening to this, hopefully you're not watching the screen, but you could probably see some of those REITs facilities off the exit ramps. So companies like Public Storage, Extra Space, CubeSmart. Those are the 5 REITs, or those are some of the REITs. And then the 6 publicly traded companies, U-Haul, they have they're not a REIT, but they have a pretty substantial self-storage portfolio. And the rest of the market is very fragmented. So there are operators like us, kind of regional operators, but there are still a lot of mom and pop operators. And, we'll share with you what that means in some of the properties we purchased, but it gives us an opportunity to really consolidate the market. And as we had mentioned, there's a premium if you can build a portfolio and look to sell that portfolio. So I think from our perspective, whether or not this COVID-19 crisis brings a huge correction in storage, and there are a lot of opportunistic buys, even if there aren't, there's still going to be opportunities because of this fragmented nature of the marketplace. So that's a quick overview on self-storage. John, and I know we're not going to give you enough time to go through an in-depth look at all that you guys do on the underwriting side, but maybe you just walk everyone through, how we look at a deal and how it goes from, hey, somebody sent us this, or we identified it, to we're going to put an offer on it.
Sure, be glad to. In terms of sourcing deals, we're on everybody's major, all the major brokers in the industry. We're on all their mailing lists, so we get a constant flow of deals coming to us that are publicly listed. Our preferred method of sourcing deals is getting them off market, or through relationships we have where we are part of a very limited audience that's looking at a particular deal. I mean, I'll just even point to this fund. 3 of the 4 deals that we have under contract were direct to the seller. We were able to get that relationship and get those deals under contract. So that's really our preferred method. Just it gives us a better opportunity to get good pricing and such. And so once we source a deal, then we have 2 kind of main cogs. We're going to look at the market and do a lot of look at demographics, look at income, look at how many comparables are in the market. Call and get occupancies, call and get rates. So we're going to really get a good handle on what the market looks like, and then we're going to go through our pro forma modeling where we're going to cash flow, put everything into a cash flow model, and see what the returns are, the cap rates, things like that. So there's the sourcing, then there's the market, then there's the pro forma, and then of course getting under contract and doing all the due diligence work from there.
Perfect. And I think it's, on the acquisition side, John brings up a great point, and I'll give kudos to Todd in this. A lot of the off-market deals come to us because of our reputation in the marketplace. And, Todd and Lou have both been in the industry for quite some time. And then, over a period of 30 years in the industry between the 2 of them, you get to know a lot of the owners and the brokers. And so I think that's a reason why we get a lot of, John, to your point, those limited looks where maybe some other operators don't. So it's something that certainly gives us a competitive advantage in the marketplace. And I'll leave this for you to read, but generally, once John and his team identify an asset, we're always thinking about it with the exit in mind, right? So typically we're building a business plan with the idea that there's going to be an exit on the back end for us and our investors. Sometimes that exit is to the REITs. That 14 property portfolio we sold was to one of the REITs, and we have a good relationship with a number of them that we can bring deals to when we're ready to sell. And then also institutional capital. We've certainly seen over the last 2 to 3 years a lot more institutional capital come in as buyers. And when I say institutional capital, think insurance companies, pension funds, endowments, people who are deploying large chunks of capital, and they're starting to be more comfortable with the asset class, which is certainly a benefit to us as far as opening up the buyer pool. So really, we're buying assets.
I'll add one thing real quick. We've talked value add. We've said that several times. A value add for us could be there's an acre of land in the back to add 3 buildings, or it also could be management inefficiencies where they haven't raised rates in 3 years. They don't sell any merchandise on site. They don't do any truck rentals like we do. So value adds has different components to it, but for us, value add could mean any one of those things. So when we talk about that, that's kind of what we're indicating.
Yeah, and I think that's the revenue enhancement portion of this strategy, right? Is we can do something to create value there, and then package it up so that it's a nice asset for the REIT or institutional money to purchase on the back end. So back to the 5 properties, and we're going to go through each one in a little bit more in depth. But here's the key assumptions that we have in our pro forma projections thus far. We have 5 properties under contract, as we had mentioned. Total acquisition cost of that is just over $41 million. The equity requirement is just over $15 million. It'll be just under 3,000 units at completion across those 5 properties and 350,000 square feet. Now, certainly, as we roll the fund out and John and his team are still working, this could change. We could add additional properties to it as long as they fit in the strategy of the fund. But this is where we stand today. The going in cap rate for that fund portfolio is just over 5%, and the exit cap that we're projecting is 6%. So, we're trying to give ourselves 100 basis points, 75 to 100 basis points between where the market is, where we're going in and where we think the exit will be. Todd and John can certainly comment on this, but I would argue that for a portfolio of this size, or $50 million equity portfolio, what that will buy. Todd, maybe you could comment on what we just saw with the 14 property sale on the exit cap rate, because I think that's a compelling and very relevant example to what we're trying to do here.
Absolutely. Once again, as Chris stated, it was a sale to one of the 6 REITs that are out there, and it was a sub 5 exit cap. So we still feel like we're being very conservative as far as being forward looking on our pro formas and making sure that our exit cap rate still gives leadway to decompression of those cap rates and still providing value for our equity investors on a conservative level.
Yeah. And so I think, if you think about exit cap, it's probably the lever that changes projections the most. And so if we just sold 14 property portfolio that looks and feels very similar to how we expect to develop this one, it's a pretty good comp. And then we're saying, all right, well, if we're going to hang on to it for 6 years, then cap rates will probably get worse. Now, they may not, but it's hard for us to project that everything will stay the same. So we try to build in that, Todd, to your point, fluff around the idea that they're going to decompress and, storage will become less valuable. Certainly, if they stay where they are now, the projected returns hopefully will be understated and everyone will benefit from that. The other, I think, thing worth highlighting is the projected rent growth of 4.5%. So that's in our pro formas. That's where we're showing the rent growth from year to year. And for those of you comfortable with multifamily, that sounds a little high. But remember that if an average rental rate is $100, we're saying that the rental growth would be to $104, or in this case, $104.50. So, most people aren't going to spend the time on a Saturday to rent a U-Haul truck and move their unit to additional facility for $4. So it's enough to continually move the pro forma and appreciate the values on the facilities, but we feel like we're being conservative there. Our expense growth typically is at least 3% in our pro formas. Certainly some items go up more than that. Taxes, depending on the municipality, we're going to make projections based on what each municipality is doing. So some expenses may go up even more than that. John, anything else that you think we need to key in on here?
No, I think we're ready to jump into the properties.
Okay. So as we talked about, and we'll go through each one, but we have 5 properties across 4 states, Tennessee, Alabama, Georgia, and South Carolina. And the goal of the fund is really to create diversification across properties, but also geographically. So if one market gets impacted by, an employer leaving or new facilities popping up or new development, we have the remainder of the portfolio. And that will be the goal of the fund, is to continue that diversification. So, I know John and Todd, Todd has been to Murfreesboro and probably can give you his firsthand account, and John has done the underwriting here and been in depth. So I'll turn it over to you, Todd. Maybe you can just give your first impressions of the Murfreesboro, Tennessee portfolio, and you and John can walk through why we like this deal.
Sure. Murfreesboro is a 2-property portfolio. It's just south of Nashville, in a growing market. When you drive through the market, you'll see condos and townhomes and apartments and everything else that would normally tick the boxes on a great market for a self-storage asset. Both of the sites sit on high trafficked area roads and thoroughfares. They are surrounded by commercial and residential. And I mean, John can speak directly to the population growth in the market, but these are Class A facilities with one of them being well occupied and stabilized, and with some room for ancillary income and some growth on market rate increases. And then the other one is a newer product, also a Class A facility that is about 65% occupied, physically occupied. So it's got some lease up room, as well as the ability to do the exact same thing that I talked about on the first one, as far as adding some ancillary income and also increasing some market rates in order to get some economic occupancy up. But John, do you have anything to add further?
Sure. I would say when we look at these deals, we're obviously looking at boxes to check, and the more boxes you check, the more attractive a deal gets. And for this deal, I would say that I would just hit on a couple of boxes. The first one would be the population. In a 5-mile radius, population has doubled since 2000. That's something we rarely ever see, and we underwrite hundreds of these things a year. The other part of it is that the growth and the development, there's over, I think, about 2,800 between single-family, multifamily units being developed within 3 miles of the site. The last thing I would say is that this corridor that these properties sit along, which is New Salem Road, these are the only 2 assets in that corridor in about a 5 to 6 mile stretch, all the way from I-24 out to the west. And there's really limited access to get from that highway up to the next major highways. So it's kind of really, it's not by itself, but it's somewhat of a limited access corridor, and these are the only 2 properties sitting there, again, inside of a 3-mile radius with all this new development. And you'll see in some of your materials that we narrowed our search of the supply even inside of that corridor to really give ourselves a good idea of how advantageous these sites are and their location. So as Todd I think mentioned, also just the quality assets. The Cason Lane one was developed a couple of years ago, and the Glenside Court property was developed in 2005 and expanded in 2017. And we just feel like they're very well located in a fast-growing market, and we're just very excited about this opportunity.
Yeah, and I would add a little bit further to that is that, you know, the market is already undersupplied. We're not banking on the growth in the market in order to continue to fill these up. The demand is already there. So as John said, these are exciting opportunities that are Class A facilities in Class A locations that we get the opportunity to take advantage of.
John, just one other piece, I think, about the RV parking, and just so people can see, I know in the picture we have that phase 2 RV parking outlined. Maybe you could explain what's happening with that and why we think that's a good addition.
Well, so there's 57 spaces in that area that you see on the right side there in the right box at the top, and the seller is adding basically surface parking for those 57 spaces, and that will be delivered to us as we close. We're really close to finishing even now, and that's just another opportunity for us, as we talked about earlier, in terms of a value add deal. In this case, we're not having to undergo the construction risk. I mean, there are no buildings, but there's still money being spent, obviously, to pave and do all the things to add that parking. So the construction risk is not ours, and we get to gain the upside of leasing those up.
And let me just ask the question I think that I would be asking if I was an investor, and it's to both Todd and John, I guess. And, you know, we talked about at our own portfolio that we haven't seen an impact on a revenue side yet. And if I were an investor, I would ask, well, how do you know the pricing you guys are buying this at is still relevant to the market? And how are we going to approach that? So as we approach the end of the due diligence period, how will we look at this to ensure that, you know, we're not essentially overbuying this site here in Murfreesboro, and in the case of all 5 properties?
I'll take that first. A standard procedure for us is to get month-end reports from the minute we get under contract, and every single month while we're under contract. We did look at the reports in March. This property, and off the top of my head, I don't remember. One of them was like up 1% or 2% in March, and one of them was roughly the same occupancy, and one of them had a little more revenue than the other one was close to even. So we're just going to keep an eye on all of our assets that we have in this fund, and we'll react accordingly if there's some significant drop off. But so far so good on all of these that we are going to discuss. So the primary way is to keep an eye on the monthly reports.
I would agree with John. The other thing that I would go back to that was mentioned previously on this presentation was that one of the reasons we get an opportunity to look at off-market deals is because of our reputation in the marketplace. We do a lot of our due diligence up front before we actually put in an LOI, and so all that being said is we don't retrade. We already know what the capital expenditures are going to be on this site, and so we know what we should be buying it for. Unless a material effect has happened on the property while John's going through and checking on the month-end reports, we would not retrade this seller, and we would look to close in a timely fashion.
Yeah, and for those of you who don't know what retrade means, it means, we go to contract on a price, and then after we go to contract, come back and say, hey, this price isn't what we're going to pay anymore. And certainly that creates a lot of angst between sellers and the broker community. I think in the environment we're in right now, certainly people understand it, but there has to be a reason. And I think to John's point, it's revenue based. So we'll keep a close eye on how revenues look. And certainly we're not going to put ourselves or our investors in a position where we're overbuying. And to Todd's point, our goal is always to maintain those relationships so that we continue to get these limited looks. And this is an interesting story as we look to the next property. So the first 2 in Murfreesboro, this is the 3rd property in Florence, Alabama. I'll kind of turn it over to John here and Todd, because I think there's an interesting story as to how we found this property initially and where we think the value is for us and our investors.
Go ahead, Todd.
All right. Well, we have a portfolio up in Florence and Athens, Alabama already of 4 properties, and we took over most of those sites with a construction aspect where we were adding net rentable square feet. All of those sites have leased up very, very well. So we looked at what was going on in the marketplace, and there are, some universities and colleges up there, and we think that market is growing, and there's only one other Class A facility in the market, and that is this one, the Safe Climate Self-Storage. John did a fantastic job, and this is yet another opportunity that is an off-market opportunity that in speaking with the current owner of the facility and having discussions for numerous months to get us to the point where we can actually acquire this one. But I'm excited about this site from the standpoint that, once again, it's yet another site that is on the main thoroughfare. It's the only other Class A facility in this market. As it leases up, it's got value add on the occupancy side as we get to stabilization, which means 85, 88% physically occupied. And it doesn't do a lot. I mean, it does have some U-Haul trucks, but they're not pushing the ancillary income like locks, boxes, packing supplies, and also the truck rentals like we do on the Reliant side. So it has a lot of upside and value to be gleaned, as well as the fact that since we're already in the market, we can push from one site to the other site as sites get full. So it really gives us an opportunity to buy the market share in the Florence, Alabama area.
I mean, Todd covered it pretty well. I'd add a couple of points. Again, going back to the market, this is undersupplied in 3 and 5 miles. In some of these smaller markets, versus, larger markets like in Nashville or we were looking at before in terms of population. What we end up finding is a disparity between the better Class A deals like this and some of the ones we own versus the rest of the market. And we're seeing that again here, where there's a lot of mom and pop operators, a lot of folks that own and manage their own properties. In some cases, don't even have an office. They just answer their cell phone and tell you they'll meet you there when there's a good time to take a look at the units. So we have a tremendous advantage over them with having on-site personnel, our professional management, and all those things. So again, undersupplied, great disparity in the between us and the competition. The property's leased up well. It's self-managed. The seller essentially, in his own words, built this just to test and see how operations of a self-storage worked, and that's what he told us. And so he has self-managed this, and it's kind of been a project for him, and yet he's got 39% in just over a year on the physical occupancy side, which is very strong. So we think it's a market share buy for us. It continues just to grow our presence, and it grows our presence with a very high-quality asset.
Yeah, and I think we have a bullet point regarding here, but to Todd's point, we have 4 other properties within the general vicinity of this one, and so it really adds a nice, crown to the portfolio we already have, and it gives us an opportunity upon exit where now we can look to sell 5 Class A type assets to a REIT or institutional capital, and they can take control or have a pretty significant presence in this market. And that's what we found many times on the exit side is the REITs are very specific in where they want to go and how they want to influence a particular market. So we feel like this is a nice capstone to the 4 properties that we already have.
I'll add one quick point to there. You'll notice when you look through all the information, there is a small expansion on this property, and what that entails is the seller has his hands in several other businesses and owns a lot of other real estate and has his own management company of apartments and hotels and different things. So he runs that out of an office building on the site. We will lease that building back to him for 3 years at a marked triple net rate. And our anticipation, it's only a 5,000 foot office building, but at the end of that lease, we will go ahead and convert that 5,000 feet to a small additional climate storage. So it's a small little added bonus to this property to not only get the cash flow on that building for 3 years, but also have the opportunity to add, I think it's 40 or 42 units after the 3-year period, after which we intend to be stabilized on the current units.
Yeah, and I jump in also and say that, just to add a little bit more to what Chris said, is that this is truly a Class A facility in these markets, and our other facilities, when we acquired them, I would have said they were a C or D, but we've then repositioned them to a Class A. But this would absolutely be the flagship in the market for us, and we can really leverage our economies of scale from the management side, from the marketing side, all over the place if we can acquire this one site.
Agreed. Shifting gears to East Denali, Georgia. John, I know you've spent a lot of time on this deal. Todd, you've been on site. What do you guys think here? What's the and maybe Todd, you can go first. What's your perspective of the site? And we've certainly had a lot of conversation with the owner, interesting guy, another mom and pop operated site that I think provides opportunity for us.
Sure. We had just been fortunate enough to take down a site in Cashiers, North Carolina. And that site is, as the crow flies, maybe about 35 miles away. And this is, North Georgia area, and this East Denali site starts adding a nice portfolio to that market. What I find extremely interesting about this site is this is another mom and pop operator. I would say he's a little bit more sophisticated than a mom and pop operator, but he still has one site. He's, put all of his blood, sweat, and tears into it. He's thought through everything. I mean, the flow of the property, where he wants to put the climate control, how he's doing the HVAC. It's Class A facility in this market. And what he's done is he's built it in stages. So he, built 2 buildings, leased it up quickly, built some more buildings, and so on and so forth. And so he's got is a fairly large property, but he's done this with, no visible marketing. All he sits on top of a hill, and what you see is the doors. I mean, he actually has no pole sign, monument sign, doesn't advertise. Even in the pictures, you can see that the office is very nondescript. So he hasn't done anything that we would normally do in order to increase visibility to the marketplace for the product, and he continually leases up. So we look at this site as, while it's a cash flowing asset right now and a very strong cash flowing asset, it's also got some value add, and I'll let John speak to that, because I think he's got another 2 or 3 acres that we would be converting to some parking, RV space, storage, because this sits right off of Lake Hartwell as well in the market. So there's a lot of demand for that. So we see pluses all the way around on this site.
Yeah, I mean, to Todd's point, I mean, he built this in 2006, so he actually built this pre-recession, and he's continually added phases little by little. I mean, never having to take really money out of his pocket. He just kind of builds the buildings, adds value, then gets a loan for the next buildings, and he's just done it over and over and over. He's actually expanded four times in the past 4 years, and he's leased up every time in probably 6 to 12 months each time. We see the opportunity is from a value add standpoint of adding RV covered parking as well as surface parking. He's indicated to us that over the years, it's week after week after week, he gets people coming in his office asking about parking. He does have 2.5 acres in the back that's completely flat, level ground. It has retention already in place that would service that 2.5 acres. The issue I'd say with him is that he actually, him and another guy manage the property. I mean, he's there several days a week, helping leasing, helping run the books. I mean, he's fully invested in the business, and I just think he's never wanted to take the time to add any more components to his plate. He does no U-Haul truck rental, and again, he has the 2.5 acres in the back, and he's just never decided to add the parking, even though he has the demand. So we see it as a great opportunity for someone like us that's able to run multiple components of a facility to come in and take advantage of things that he's frankly has a demand for and just never has taken advantage of. So again, it's that direct to seller, it's that limited look at a property where you really can take advantage of things that are really sitting there right in front of you to take advantage of. Just the seller has not had the ability or the desire to do it.
And John, would you say, as far as the competitive set, this is the only Class A in this market?
Yeah, it's. I talked about that with Florence. I'd say it's even more enhanced with East Denali. The competitors are a lot of times 1, 2, 3 buildings. Again, no office. Don't answer the phone. I mean, go down the line of the check boxes. It's between him and the competition. It's 2 different playing fields, and I think that's why he's done well. I mean, he's got 104,000 feet of storage, and he's 88% full in a relatively small market. It's south of Toccoa. Population size is not robust, and he has got a very large facility that stays full no matter how much he adds to it. So the opportunity for us is fantastic, and we're excited.
Yeah, just talking about the RV and covered parking, I would add boats to that. The facility's very close to Lake Hartwell, which is on the border of Georgia and South Carolina, and one of the largest freshwater lakes here in the Southeast. And I can speak as a boat owner that a lot of facilities are built to cater to those boat owners right next to the lake. So I think there's an opportunity here for that covered parking. In fact, I dropped my boat off at a storage facility not too far from here. Luckily, I know a guy who provides us with good storage opportunities. But I think certainly Lake Hartwell is going to help drive that for the RV parking.
And I'd add in our research, we called all the RV boat parking facilities around Lake Hartwell, at least on this side of the lake, and they were all full. Maybe not 100%, but they had 1 or 2 of a certain size, and they were all seemed to be adding maybe a small building of 10 more units. So just the demand seems to be very, very strong for that product type to go in conjunction with what he has said about people constantly asking him for that type of storage as well.
Thanks, John. So transitioning to the 5th property, and this one's kind of an interesting story. And for some of you investors who may be invested in Reliant Self-Storage Fund 1, it ties into a property we purchased at the end of 2019, Murrells Inlet. And John, I know this one was kind of near and dear to your heart. Maybe you could share with us what happened with this property, because it's certainly a unique situation.
Yeah, sure. So we closed on the Murrells Inlet property, and you see on the screen, you see those two buildings with the white roofs. Those are the climate-controlled buildings that go along with the Midgard Murrells Inlet that we closed in December. Across the street and just a couple of blocks down the road, you'll see on the left picture those drive-up units that go along with the property. As soon as we bought this, we already had it was in our mind to try to pursue these units directly next door. It's a situation we literally can clip out, 8, 10, 12 feet of a fence and connect the two properties. So we took the opportunity to directly contact this seller, and we were able to get these under contract. There's, I think, 123 units, if I have that in my head right. They actually finished March at 90% occupied, up 10% from when we put it under contract about 3 weeks ago. So they're continuing to lease up at that property as well. We're just excited to combine everything on one side of the road, which is going to be a better profile for us on an exit strategy. In addition to the two white buildings there, we're adding a third building that'll probably have a white roof as well, right to the next to that, and then we'll be adding another building out by the road, kind of parallel to the road and perpendicular to these buildings, to give us even more visibility. So this is going to become certainly a flagship in the market, and like I say, give us a better opportunity to have a consolidated group of units.
I think one other thing to consider is that we own another facility in Pawleys Island, South Carolina, about 8 miles to the south of this facility. And we did an expansion there that was completed early this year and has started a really strong lease up there. So, to Todd's point about creating a corridor in Florence, Alabama, with part of our other portfolio, I think that is how we're thinking about this too, right? Is we have the opportunity to create flagship type facilities on this Highway 17 corridor, which again, if you're thinking about it from the exit side of things, makes it a very attractive proposition for someone who may come in and looking to create a presence in this market. Todd,
and I would add, I don't want to beat a dead horse, but again, disparity of competition. Again, we see it here as well. I mean, there are a couple of stronger competitors, but there's a lot of mom and pop in this market. Again, with no office presence. I mean, I don't want to beat a dead horse, but it's just something we find and are able to take great advantage of.
Todd, anything else you'd like to add here?
The only thing I would add is that by acquiring this site here as well, it balances our climate control, non-climate control unit mix very, very well. It gives us a good balance, and it just is a no-brainer for us as far as being able to connect the two facilities and go forward.
Perfect.
One more thing really quick before you leave that slide. Traffic count, 38,000 cars. We haven't talked much about this, and I won't go into a tremendous amount of detail, but storage has become a very retail business, and traffic count and visibility to passerbys, so to speak, is huge in self-storage, and this site at 38,000 cars is extremely strong.
Yeah, appreciate that, John. So it's been just about an hour, and I want to go through a couple just frequently asked questions, and then we'll wrap it up. Appreciate you guys being patient with us. But that takes us through the 5 properties that that we've seeded the fund with. And again, my perspective of this is, although we're building the fund with these 5 properties in mind, we're going to keep an eye on revenues there, and perhaps maybe our acquisitions on these may change. But the goal of the fund is to be prepared for what we think is coming as far as opportunity. And even if that may not happen, we're going to continue to underwrite deals and find great opportunities in the market to help consolidate a portfolio. So just a real quick thing I wanted to touch base on, the target returns of the fund. We're shooting for 4 to 7%. And obviously that's going to change as we add more properties to the portfolio. but for your annual returns paid out quarterly, that's what we're expecting to pay. That 12 to 15% range is what we expect to pay out at the end of the 6-year hold when we sell the portfolio. So again, that if it's 15% multiplied by 6 years, that's a 90% return. So that 90% return includes all your quarterly distributions plus the profit from sale. We talked about the term of the fund being 6 years. You know, something to consider, a downside to these types of investments is the illiquidity. There is not a liquidity event until we sell the assets. So it's just something you want to consider as an investor. If this is money that you need in the short term, you should not invest it in these types of vehicles. Will we use debt in the acquisitions? Absolutely. That allows us to build a big portfolio and support a higher cash flow rather than an unlevered return. We'll endeavor to keep the portfolio between that 65 and 70% loan to value at the portfolio level. We talked about investors will not guarantee that debt. You know, it's signed if there is recourse required by the lender. The principals of Reliant will sign on that note. Who can invest in the fund? This will be a 506C offering under the Reg B exemption with the SEC. So you have to be an accredited investor to invest in the fund. You can click on that link to a definition, but accredited investor essentially is you have a net worth of over $1 million, excluding your private residence or your primary residence, or you have an annual income of above $200,000 or $300,000 if you have joint income. The minimum investment, just real quickly, is $50,000, but keep in mind if you're part of that first 10 million that's raised, you're able to qualify for those Class A shares, even at the $50,000 minimum. We talked about how much Reliant is investing. This is a question that I wanted to make sure if we don't raise the $15 million, then the question is, well, what happens? We would return that capital to investors. Certainly we just finished Reliant Fund 1 and raised $47 million in just over 8 months. So even with the volatility that we expect in the market, we're confident that we're going to be able to raise that $15 million. Can you use 401k money or self-directed funds, or qualified funds, self-directed IRAs or 401ks? Yeah, you certainly can. Your IRA or 401k custodian would be the person to validate whether or not they can invest in an LLC, but we have lots of investors who utilize those types of funds. We have not projected any refinances in the fund returns. So certainly if we are able to refinance some of those properties as we build out the portfolio, it would help supplement the returns, but we don't include that initially. When does my 8% preferred return start to accumulate? So it's when your capital is deployed, or if we're not able to deploy the capital, but we take your capital, it's day 91. So typically we usually have more properties than equity, so the capital gets deployed pretty quickly. But if for some reason we were to make a capital call and hang on to your money, day 91, it would start to accrue whether we've deployed it or not. A question we get from investors a lot is how do we communicate with investors? There's a quarterly update that allows you to hear from us as far as what's happening at each one of the properties with a quarterly statement, in addition to the distributions. We can certainly send you a sample of that. We also try to get our K-1s out in 2019. We had them all out by March 15th to allow you to prepare for taxes. It's something that we work really hard to make sure we're not going to hold up the tax returns. We talked about the fee structure, but that goes through what the fees are. Again, if you have additional questions, you can certainly reach out to investor relations at reliant-mgmt.com. This will all be posted on our website as well, reliantinvestments.com. There will be access to the due diligence documents. So John and his team have put together a folder for each one of the properties where you can look at the pro forma, the comp study, and then also the roll up of where we're getting these projected returns. And in this deck, which we'll have available for you, there's some more information on us, why we would ask you to partner with us, specifically things about our track record, a more in-depth look at the team biographies, and then a case study for each of the last properties we've sold, the last 5. Now, this does not include that 14 property portfolio, as we've not finalized the numbers from that, but these are the last, this one that we're starting with here was sold in December of 2019. This was April of 19 and goes back. So just gives you a sense of what types of returns we've seen with our most recent dispositions. So with that, I will wrap it up. Todd, I don't know if you have any additional thoughts. John, let me just say this. If you're interested in holding a spot in the fund, you can reach out to us here or investor relations, or schedule a phone call through our website to talk in more detail. But I appreciate you guys taking the time, and I hope everyone's going to stay safe through these crazy moments. John, Todd, anything to add?
I mean, I'd add that, I'm very excited about this portfolio, in these uncertain times. It's nice to be able to provide an opportunity in an asset class that performed very well during the last downturn. So we look forward to earning everybody's business out there.
Yep, just thank everybody for joining us.
Guys, well, I appreciate it. Hope you have a good rest of the day, and we will talk to you soon.